Would you pay $16,000 in closing costs just to lower your monthly payment by $150 a month? Because this is where homeowners need to stop just looking at the payment and actually start doing the math. A lower payment sounds good, but if the cost to get that is too high, a refinance may not actually help you. For those of you who don't know, my name is Kay, giving you the real keys to homeownership so that your first buy does not become your first regret. Let's get into it.
So I bought a house during COVID and my interest rate was 2.25%. I ended up having to move for work, and then I bought a different house in a different state. And at the time, the interest rates were crazy. So my interest rate on this house is 6.75%, which is crazy. So, the feds just dropped the rates today. So my friend that works in the mortgage industry, she's like, girl, you need to refinance your loan. Like the rates dropped today, yada, yada, yada. So I'm like, okay, let me hop on it right now. I spent 40 minutes out of my workday talking to these people. I called 2 places. And y'all, are these people out of their cotton picking mind for my mortgage to decrease by $150? The closing cost on my loan is $16,000. I literally did not hang up the phone quick enough. I was like, oh, gotta go. Thank you. Like, are they crazy? So, anyways, I don't know, like, if I just misunderstood this whole refinancing process, but I thought it was gonna help me. Like, $16,000 for y'all to push through some papers and press a button on a computer. Like, what? So, long story short, yeah, I'm confused on this refinancing thing. So if y'all know how this process works or how is it even really beneficial to refinance your mortgage, let me know.
So she's definitely asking the right questions, because the question just isn't, will my payment go down? But it's, how much is it going to cost me to get that lower payment? And then whatever it's going to cost me, how quickly am I going to break even? Is this refinance actually going to benefit me? The lower payment does not automatically mean that it's a better loan. If you're going to pay $16,000 to save $150 a month, you need to figure out how soon or when you're going to break even for that to even make sense. So let's just use the example she gave and do some math. If the refinance costs $16,000 and she's going to save $150 a month, you're going to take $16,000 divided by 150. That gives us about 106 months, which is almost 9 years. So if she paid $16,000 to save $150 a month, she would need to keep that loan long enough for the monthly savings to catch up with the cost she paid to refinance. If she was to sell, refinance again, or move before that break-even point, then the refinance was in vain. There's really no benefit to what she did. A lower payment is only going to help if the savings are worth the cost. I know a lot of people, they look at refinances and they're like, why the heck are the closing costs so high? In her case, she's like, to save $150 a month, you want me to pay $16,000? That doesn't make any sense. And it doesn't. But the reason they're so high is because every time you do a loan, it's like you're starting over. All of those lender fees, title fees, your taxes, insurance, the escrow setup, all of the things you paid the first time to get into the home, you're having to pay again. A refinance is a whole new loan. You haven't bought a new property, but it's a whole new loan. You don't have a down payment, but it does come with closing costs. So just like you break down the closing costs on a purchase, you should do the same on a refinance. You break them into buckets. You have your lender fees. That's your origination, your processing, your underwriting. Those are the fees that your lender has to get your loan originated. Then you have your third-party fees, your title fees, your credit report fees, your appraisal fees, your survey fees, pest inspection fees if needed, things like that. Those are going to be paid directly to those companies after the loan has closed and not to the lender. Then you have your prepaids and escrow, your homeowner's insurance, your taxes. If you have any mortgage insurance premium or private mortgage insurance, that's going to be in there. And your prepaid interest to reestablish your escrow account if one is needed. Then lastly, you have your discount points, if any. If you're working to lower your interest rate, those are the monies that you pay upfront, the prepaid interest, for you to be able to get that rate. Every loan doesn't have that, but some of them do. It's good to know what it is. So before you look at the closing costs and be like, whoa, they're tripping, they overcharged me, first ask what is included in that. Now, I agree. I don't think she should refinance to save $150 a month if it's going to cost her $16,000. That doesn't make sense to me. I wouldn't do it. But in some cases, refinances do make sense. This is just one of the instances where it didn't. When it comes to discount points, that can make sense if, like we did the math with your break even point, if you're going to be there long enough for that lower interest rate to benefit you. But if you end up moving or selling before, it doesn't make sense to do either one of those things, because then those points don't help you as much as you thought that they were. So always remember, do not ask for a lower rate until you've asked your lender, how long is it going to take for that lower rate to pay me back? Another thing that I want to hit on is that the closing costs are often rolled into the loan, which just means they're added on the back end of the loan. So that can make you feel like you're not paying them, but you definitely are. Rolled into doesn't mean, the lender's taking care of it. You're paying for it. So in many cases, your loan balance will increase. And then it also in turn causes owners to lose some of their equity, because all of that money that you've paid over time, all of that equity that you've built, when you add those $16,000 to your loan balance, it's like you haven't made any progress. They're just taking those costs and adding them to what you already owe. I also want to hit on the lower payment trap that's out here, okay? Because a lot of people are got with the fact that, oh, we offer you a lower payment. We can get you a lower payment. Well, there's a lot of ways that somebody can give you a lower payment. A lower payment can come from a lower interest rate, a longer loan term, rolling the costs into the back end of the loan, removing your escrow, paying the discount points up front, changing the loan structure, restarting the loan term you already had. And that is why you cannot only just look at the payment. You have to look at the loan as a whole and what's going on. Because a payment can be lower, but the total cost of getting that can still be higher. If you're going to take a lower interest rate, more times than not, you're going to have discount points to pay. If you're financing on a longer loan term, over time, you're going to pay more interest. If you're rolling those costs into the back end of the loan, you're eating away at your equity that you've paid off. It's like you're starting back at ground zero. Overall, a lower payment can still cost you more if you don't look at the full picture. The warning here is just to understand what you're signing. Just like when you're purchasing, you need to do the same due diligence when you choose to refinance a loan. In order to make sure refinance makes sense for you, here are 6 questions that I would ask before I do so. Question number 1, what is my break-even point? Meaning, how long will it take the monthly savings to repay the cost of refinancing? Question number 2, how long do I plan to keep this home or this loan? If you plan on refinancing again or moving, refinancing at said current time may not be the smartest decision. Question number 3, are these costs being paid up front, or are they going to be rolled into the back of my loan? Just know if they are rolled in, your loan balance may increase. Question number 4, am I paying points? If you are paying points, make sure you ask your lender, does it make sense for me to pay these points? Is it going to be a benefit to me depending on how long I plan on keeping this home or this loan? Question number 5, is my loan term restarting? If you're going from a 26-year term to a 30-year term, yeah, your monthly payment may drop, but the overall interest you're going to pay over the lifetime of that loan is way more than if you would have kept your 26-year term. And then question number 6, is the lower payment because the loan is truly better, or just because it's been structured differently? And that question really matters, because a lower payment, as we've seen, can come from more than just a better rate. I've given some of the warnings and things you should look for when you are refinancing, but that's not to say that refinances are bad, because they are very useful when one makes sense. Overall, we don't do anything just because someone tells us to, but when it comes to refinancing, just because someone said the rates are going to drop doesn't mean that's going to make your loan better for you in the long run, and doesn't mean that you should refinance. You definitely have to weigh the benefits with the costs. Also, too, just like when you're purchasing, you should shop lenders. Compare them early. Don't get verbal promises. If they'll allow you to compare their actual loan estimates, look at things like the interest rate and the APR and the loan term they have you on, the points and the lender fees and the monthly payment and the loan balance and the cash to close. All of the things that you need to be on the lookout for. Compare the two and go off of what the numbers say who may have the best deal. Don't automatically look at the lowest cash to close or the lowest payment. A loan is like a story. When you're reading a story, you shouldn't jump to the middle. You shouldn't jump to the end. You have to start at the beginning to understand what's going on. So when you're comparing loan estimates, you need to look at the whole thing to compare what's happening and really be able to make the best decision for yourself. Now, if you're in a position where you've researched financing and you have a lender that tells you refinancing will save you money, I want you to ask them this. Can you show me my break-even point, my new loan amount or new loan balance, my total closing costs, whether any points are included, and how much will I actually save over the time that I plan on keeping this loan? And if they cannot explain any of those things to you clearly, I advise that you slow down, and if you haven't shopped lenders, that you go ahead and do so. Do not ever just sign a new loan because the payment sounds better. Remember, loans are like stories, and we need the full picture before we can make a good decision. So, would I pay $16,000 just to save $150 a month? Based on that math alone, I would need a really good reason to do so because that break even point is almost 9 years. Now, I don't know her full situation and other factors, but like she said, if we're looking at $16,000 cost for $150 a month savings, I would have hung that phone up quickly too, okay? Because it's not that serious and it's not something that I would rush into. That's a lot of money to borrow or a lot of cost I'm accruing just to save $150 a month. And for me to have to be in that home another 9 years for me to reap a benefit, I don't know. If you're thinking about buying, refinancing, or just trying to understand your numbers better, that is exactly why education matters and why I offer consultations. I am a licensed agent in the state of Texas. My truck number is 768-070. We can get on the phone, talk about your goals, your numbers, what the reason for you wanting to refinance is, and I could get you in touch with my preferred lender so that they can work something out for you. The link for that is in the description below. So the biggest thing I want you to take from this video is just because you have a promise of a lower payment does not mean that's the best decision for you. Weigh the whole scenario of the loan, shop different lenders, and pick which one seems like the best deal to you. And if none of them seem like the best deal, there's nothing wrong with waiting to refinance. Just because you have the ability to doesn't always mean that you should. Be sure to keep watching the channel and check out these next 2 videos to continue helping you on your home buying journey. Because remember, when you know better, you definitely buy smarter. Until next time, see you in the next one.